Your hosts, Tony Mendez and Gordon Hines.
Welcome into the Real Estate Report. I am Tony Mendez.
And I'm Gordon Hines.
Thanks for joining us today. We have a great show for you. We are live in the Bay Area, but we are talking everything Bay Area and national real estate, anything that pertains to you. We are your second opinion, and we're here to empower you to make the right decisions in real estate. At least be that second opinion, like we said. It is a drive time, but if you can get a chance to give us a call, we are live, 800-516-1220, 800-516-1220. You can also email the show, Tony@BayAreaLoanSource.com or Gordon@BayAreaLoanSource.com. We love scenarios. In fact, I know Gordon's kind of itching to go over a couple of emails that he got just recently. Just tease us a little bit on those so that people can...
Yeah, every week, sometimes we don't always get to our emails because it seems like this is the fastest hour in show business. But people email us questions that don't get a chance to call us on the air. I've got two really great emails. An email especially is a guy who's his mother's 90 years old. And he says she's running out of money. She's actually outlived all her savings and retirement because he didn't think she was going to live this long.
So sounds like that's going to be a reverse mortgage topic then that we can talk about.
Yeah. I mean, this is going to happen to a lot of us as technology and medicine gets better. We are going to live longer. And a lot of us are going to actually outlive our savings. So we got to do some different things to kind of prepare for it, especially if longevity is in your bloodlines.
What's your other email?
The other email is the lady who sent me a great scenario 12 years ago, actually. Her and her sister, younger sister, both refinanced their houses. And she elected to do the 30-year and her sister elected to do the 15-year. So I'll give you the results of that actually a live case.
I will like that scenario a lot. I know a lot of people... Especially if you're searching for a mortgage or you've searched for mortgage, these search engines are fantastic, but they also tag you with ads over and over and over, and you're going to see the ones that say so and so is urging everybody to switch to a 15-year or a 20-year, or even an ARM. I've seen people advertise for ARMs or lenders. So it can get kind of confusing. I mean, one of the topics that we hit every week is interest rates, and I'm following interest rates primarily this week because they are dropping. Trump did something kind of crazy today, and he's tweeting out stuff about what he said. They canceled that big CEO council that he had. Markets kind of took a sideways turn. Then we had the Fed meeting this week, and they said, we don't know about interest rate hikes, and the markets are like, this puts more money into bonds, and that's driving interest rates down as well. And I'm not talking these are super... changes, but
between a quarter and an eighth, we look at.
Yeah, but when that happens, we see applications start picking up. We see people look a little bit longer at those ads that they see online, and they want to know what to do. And I think it's great that that you think about it, because I always call it managing your mortgage, and managing your mortgage was the thing that I've been doing for years on my properties. And like you just saw, you have that email about the people who are looking at a 30-year or a 15-year, and then what does it look like 12 years later? A lot of people are going to think about that. So that's what we're here on the show for. We're here for your second opinion, but we'd love you to send your emails to us, Tony@BayAreaLoanSource.com or Gordon@BayAreaLoanSource.com.
Plus, this is a great time of the year. The school is almost back in session. We're beginning to see the back-to-school ads. We're at the end of the summer. We're going to move into the fall season. This is the second busiest time of the year. Fall is very, very important for home sales. People are always looking to get in homes before the holidays. And if rates are low, I'm seeing a lot of inventory now come to the marketplace. Every day I get these emails about different properties come on the marketplace. They're not cheap, but there are more and more properties becoming now available for sale. So it's going to be an exciting fall season. And I'm strapped in and ready to go with the applications coming in. And we're going to close a lot of deals and help people become more homeowners in this fall of 2017.
Yeah, there's probably a little bit of inventory built up from the summer. School started, everybody's like, okay, I can spend a little bit more time putting some paperwork together, a little bit more time running some numbers. Maybe you're like, the kids are out of the house now, we can have a serious talk about whether or not we want to move or buy upgrade, or if you're renting, buy a house, where maybe you take some trips out to some neighborhoods and start looking at them. So these are the things that we're going to start seeing in the fall. I do think it's going to be busy. There's a lot of pent-up demand, Gordon, still. Every realtor I talk to say they have at least 2 or 3 buyers just waiting to find houses. And you add that all up, and there's a tremendous amount of opportunity there for sellers especially. And interest rates, we've been seeing them change. 30-year fixed at 3.89% according to Freddie Mac on the 30-year fixed. The ARMs are dropping as well. They're in the lower threes. But like we said, the big news this week was the Fed meeting. 50%, Gordon, of the committee believe that the Fed should act a bit more cautiously about raising rates this year. And we saw the market react right away.
Yeah, but keep in mind, if you the great thing about us, we can always go back and see what the market was doing 6 months, a year ago. For 2017, the Fed announced they were going to try to make 3 to 4 increases. So if they make one more increase, that's right in line of what they actually kind of predicted. So that should be right in line and what the market should be prepared for. And the market always prepares for rate increases before it actually happens. So if the Fed's going to raise rates tomorrow, you'll see rates start to go up last week to kind of, I guess, absorb the shock of what the market's actually going to do.
Kaplan, the Fed president in Dallas, said in a speech he wants to see more evidence of a rebound in the midterm a rebound in the economy, I'm assuming, before he would support another hike. He would later say in this speech, as the bond yields flatten and invert, it's a sign of a troubled economy, and that we, the Fed, need to be patient and judicious in the moves. His counterpart in Cleveland, Mester, offered a counterpoint saying, I don't think the long-term bond rates being low as a signal we are going to a recession, and that the rate will go up as we remove accommodation. So there's a couple sides here, Gordon. And those who are in real estate who have really enjoyed what I would call the glory days for many years, right? Low interest rates, improving home prices, improving employment, low inventory supporting higher home prices. Basically, real estate got the better of both sides in this deal. And I could argue that we may be seeing the first signs of a hole that we may have dug, and the economy is running out of we're running on full cylinders. Rates are pretty low right now. Where's the relief going to come from? In sailing terms, we would use this in sailing. If we get too much wind, we ease the sails. But if we can't ease the sails anymore, the only thing we could do is turn down.
Well,
point a different direction.
That's a great point. I think if you look around in all the neighborhoods, especially some of the challenged neighborhoods, you go back to like 8-9 years ago, 2009, 2010. You saw a lot of distressed properties, a lot of rundown neighborhoods. And of course, a good economy is a cure for all that. A lot of the less desirable neighborhoods now are more desirable than they used to be. You're seeing home improvements. You're seeing people fixing up, buying, painting, all kinds of things. This is all good. This is all the fruits of a robust economy. So as we look to the future, and if we can continue this economic growth, I mean, this should really help some of the challenged neighborhoods and the parts of the city that were less desirable become more desirable, and you'll see things begin to turn around for all sectors of the economy.
Home Depot, right on that point, I think they beat their estimate for their quarter by like 9% or something crazy like that. So you're seeing places like that profit and benefit from the people putting money back into their homes. A little bit of that is people can't move. They're kind of locked into their house, and they're saying, I'm going to spend some money. You might as well put it into my house and make this the best place that I can live in. Or people are moving and saying, I'm fixing up this house. And I mean, that's been one of the things that I've seen in California more than anything else, Gordon, is people, especially people without kids, but I have seen it with kids, and couples, they'll move into a house, they'll fix it up and sell it. Move into a house, fix it up and sell it. Move into a house, fix it up and sell it. And I think those opportunities are still here, especially if you can be flexible with your work and your schedule.
One of the challenges that we get all the time is when we deal with senior citizens, the mature, I call it the mature homeowners. One of the things that they always say is kind of really hard to scale down here in California. A lot of them have, families have grown, they're empty nesters, might have this 3,000 square foot house, 2 levels that they really don't need anymore. A lot of them said, Gordon, I'd like to scale down to a 2-bedroom, 1-level house, 1 bath. Something along that line, just an extra room for the grandkids to come by. And they say, boy, we can't really sell. We can sell, but we can't buy the smaller house because the market is so robust and prices are so high. I guess that's a good problem to have if you want to look at it that way, unless you'd have to relocate out of the state. But I guess that's a good problem to have where you have a lot of money, you just don't have the option of scaling down. That's one of the challenges we always hear from a lot of senior citizens as far as housing is concerned.
Yeah, and to keep the convenience, of course, there's ways you can always downsize and move. But like you said, a lot of these mature homeowners want to stay in their community, want to stay near their friends and family, and all the other amenities that they've been used to. And downsizing just doesn't work. There's not a lot of new homes being built. In fact, we're going to have a story later about home builders and how they're still running out of labor. And they're struggling. They're struggling to find people to build homes, which is crazy because there's people looking to buy homes. So we're having this kind of weird scenario where nothing seems to be right, but except the people who want to buy homes.
Well, that's one of the things that they say that's an outcome of some of this crackdown as far as illegal immigration is concerned. A lot of the farms are running out of farm hands to actually farm some of the fruits, because there's less and less people, quote unquote, coming across the borders these days. So if it's a small pool of labor and everybody's vying for the same labor, labor prices tend to go up, and that's the reason why you're seeing these H-1 visas and all those things bringing in foreign people to work. Is a big part of the economy right now, because we have to be able to fill these positions that we're trying to fulfill. There's a plan, I think, in Ohio that they're trying to build a big another car plant. I can't think of the name of the car plant, but they were saying they don't have enough labor there because there's not enough people there. Skilled labor is a word I'm looking for, not just labor, to actually function in these jobs. So that the job training, trying to bring in foreign workers to help get up to speed, it's kind of challenging. It's kind of interesting. That's a good challenge, I guess. Huh?
33% of all builders reported serious shortages in framing crews, 29% in carpenters, 23% in finished carpenters, 19% in bricklayers, concrete workers, drywall, and the list goes on and on and on, all the way to building maintenance management. There's serious shortages. So we're not seeing the building that's necessary for people to make those moves and that accommodation.
Well, that's one of the things you always tell me. You like to build, so yeah, you might have a job, another job. You might have a second career to moonlight, home building.
We're going to see what happens. What was interesting, Gordon, when we first started hearing these stories about the shortages, and that was going back all the way to 2012. I was telling people back then to get into the home improvement business because there is a big short. You know how long the wait is for somebody? I have a client that took out $20,000, wants to fix their garage. They can't find anyone. They got the money, but they can't find anyone to do it for 2, 3, 4 months.
Lady told me the same thing at the coffee shop the other day. She's trying to remodel her bathroom, and the guy that she had thought she'd hired that was supposed to remodel the bathroom since March, but I guess every time she called him, he's got other jobs. I guess he's going for a bigger job
yeah.
And don't want to just do a small remodel. And she's saying, boy, I can't find somebody to remodel my bathroom.
I'll tell you, if I was to get back into another business, that would be it.
Home building?
Well, not home building, home improvement.
Repair. Okay.
You call it home repair?
Home repair.
You don't call it home improvement?
No, home repair I call it. You say repair,
yeah, but
I say improvement.
If you say repair, that indicates that there was something damaged. Some people don't have damaged houses, but they want to improve it.
Well, if you improve it, you improve it. You don't improve something's good. You improve something's damaged. It doesn't.
No, I can have an old toilet that's not damaged. I want to improve it.
But it's damaged to your thought process because it's not serving the same
process. It's damaged to your thought process?
Yeah, I call it home repair.
Join in that conversation. I'm right in that. I know I'm right. You're welcome to chime in. Anyways, 800-516-1220, 800-516-1220. You can email the show, tony@bayarealoansource.com. We'll be back after this break. I'm Tony Mendez. That's Gordon Hines. It's the Real Estate Report here on AM 1220 KDOW. Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
Thanks for being with us today. You can always call the show, 800-516-1220, 800-516-1220. Remind me to say that number more often, Gordon.
Or you can fax us, 925-299-5395. If you're bashful about calling or emailing.
I'm going to bet there's a lot of people out there that are listening to the show that don't even know what a fax is. Well, or have never. I'm sorry. You probably know what it is. You've never used one. Recent study from CoreLogic on the impact of higher rates on the real estate market showed that affordability remains the number one concern for buyers. But it also showed that affordability is still well below the level seen during the last peak, all based on 20% down on the average interest rate for the median priced home, showing that in 2017, in June, the average payment for a purchase was 47% less than it was in 2006.
Wow, that's incredible.
Okay, that's nationwide. Study also shows that adjusted median price for 2006 at 241,500. Today's study shows the median price at 225. So there's a little bit of room for the median home price to grow based on inflation. Because the story here is, I think there's room for interest rates to fluctuate, even in the 1 to 2% range before we see affordability be a factor, unless home prices continue its pace.
Yeah, medium home price is always confusing. There's no such thing as a medium. It's an average. I don't know why, for some reason, they always use that medium as a statistical data. I think it's better off doing an average home price. More people, it's more effective. More people can relate. Medium means the price in the middle. Price in the middle.
No, 50% of the homes are
Yeah.
sold for over that much, and 50%.
Yes, it's kind of confusing sometimes to a lot of people that said when you anytime they heard the word median versus average. So there you have it.
That's your opinion.
The difference between median and average.
I thought maybe you'd talk a little bit about affordability and interest rate. Well, anyways, the median home price, I think if it continues on its path, that equals about, which is about 5 to 6% year over year. That equals about, and a half a point increase like we saw over the last 12 months. That combined equals about a 12% increase in payment, and that gets us a lot closer to what we saw in 2006. So at our current pace, maybe in a year or two, we might be at that affordability level we saw back in 2006.
Well, probably the difference, one of the differences that I can think of back in 2006, that was the height of the 100% financing. Now, of course, if in the marketplace that we're in with qualified mortgages, and if you mentioned with 20% down, that's a substantial profit equity position to reduce a home price by, as compared to in 2006 where everybody was doing 100% financing.
Yeah, it was a really interesting time, which is interesting too, Gordon. We're almost right back. We do 95% financing with first and second loans. FHA goes to 636,000 96.5%, and VA does 100% financing up to 636,000 in the Bay Area. So we're right there. But to get to that higher, the median home price in the Bay Area, I think was 834,000 or something crazy like that.
It's a big number.
You can get there with 5% down.
Yeah, we're doing a home right now.
And stay in an A paper loan.
Buying a $900,000 home with 5% down on a condominium over in the city. It's kind of interesting as we see as the market gets better, and you'll see more and more products that we always talk about that drive the market come back into play. So we got a 95% jumbo product on the condominium, which is only a 5% equity position, and you can do no MI or self-insured MI. It's kind of interesting as the market gets better, how many products come back in the marketplace, which kind of really drive the market to another level. That's what I always see.
I had it somewhere, but there are starting to see more stories about Alt-A product. Alt-A is kind of the new subprime. A lot of people say FHA was the current subprime, but they really are. They're portfolio loans. And really what we're talking about are guidelines and the programs that follow these guidelines. And as lenders figuring out that we need to get more and more volume, we need more people to qualify, and we increase some credit score here, and we change this little guideline over here, we can sell this as an A-paper kind of product and offer a little bit higher margin on the rate and make some good money. And they work off their algorithms, and that's how a product comes out. And one lender is going to push another lender, another investor is going to push another investor, and it's going to continue to the point where they're just looking at equity and strong positions with these borrowers. And we're going to see more and more of these products hit the market.
But that always happens. That's what they say. Competition brings out the best in us, right? So we'll see.
We will see. You can always call the show 800-516-1220, 800-516-1220. I'm Tony Mendez.
And I'm Gordon Hines.
Gordon Hines. We'll come back after this break here on AM 1220. This is the Real Estate Report.
This is Money 2.0 on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
Thanks for joining us. You can always call the show 800-516-1220.
We love that you listen every week, by the way. We appreciate the audience.
And all the emails, Tony@BayAreaLoanSource.com and Gordon@BayAreaLoanSource.com. We love all the emails. Well, let's hit one of your emails, in fact.
Oh, man, this is a great email. In March of 2005, my younger sister and I both refinanced. We took out a loan of $300,000. She, of course, more financially savvy than I am, opted for a 15-year loan. She made less money than I did, but I had 2 kids, so I had a little larger expense. So I didn't think that I could afford the difference in the payment between the 15-year and the 30-year. The payment was actually $693 difference. 12 years later, neither one of us has refinanced, and I'm flabbergasted to see that right now she owes less than $65,000 on her home, has less than 3 years left to pay. In 3 years' time, her house will be paid off, and I've got $225,000 balance on my home, and I got another 17 years to pay. Boy, what a difference the 15-year makes. I wish I had refinanced into a 15-year like my sister did. We see that a lot.
So this is a topic that a lot of people are going to start looking at in the next couple months.
Especially since rates are low.
Rates are low. There's a little bit more time in the household if kids go back to school, and they can start thinking about whether or not a 15-year or whatever makes sense. Equities have gone up. Are we going to take some cash out? Are we going to pay out some other debt? Those are completely other topics that we can hit. I think there are still tons of money that are sitting on the table that people are not accessing by not paying off high interest debt like credit cards, even car loans. I saw somebody with a car loan the other day. They got 3.99%, and they had decent credit. People aren't, and I wanted to tell her, I was like, you could get better rates, with credit unions on car loans and things like that. But there are some high debt that you can pay off, but we're not going to get in that story. The 15-year and the 30-year, Gordon, that is a huge difference. I think comes out to about 1/3. I think you pay about 1/3 less.
It's not double. Anytime you mention 15,
it's more than 1/3.
Most people think it's double. It's not. It's not double. It's like less. It's about more than 1/3. The difference, of course, is amortization. And now we do have one of the loans that we're finding people are stretching to. Sometimes the 15-year might be too much of a big stretch. You can go for a 20, or we can over do a 25-year loan. But anyway, all you're doing is by cutting that loan period shorter, that's going to allow you to pay that house off a lot sooner and build up the equity, even if you're not trying to pay the house off. Equity, have another option. Your cheapest money, we always talk, is going to come on your house. Primary resident, owner-occupied. You can't borrow money cheaper than that unless it's from your relative.
The other way to look at it, too, is the other person who got the 30-year fixed. 2 kids, couldn't afford the 15-year payment. She needed the money.
Well, but she said she thought she couldn't afford it, but now looking back in hindsight, she says she wished she had. She would have found a way to afford it. She would have probably cut back on drinking. Who knows?
Well, sometimes that does force you, let's say you do get the 15-year, it does force you to make that commitment toward
Absolutely.
it and have that obligation. Something in real estate that a lot of people that I would say on the higher end of the risk scale kind of convince themselves that if they get the house, they're going to find a way to make the payments, just qualify. And I've kind of followed that when I bought my first house, Gordon. I said, you know what? I'm going to work for 2 years as a commissioned person, and I qualified, and we bought what we thought we could afford, and then I was able to do whatever I could, and we always were able to make a payment. In fact, I wish I bought more. I'm not saying that I wish I went to a 15-year, but you understand that obligation that you have to make. The flip side of this, and what I was trying to get to, is that maybe she doesn't have kids, and maybe she just wanted some extra cash flow for other investments instead of burying the money into a property that will get paid off sooner than later. And of course, age plays a big thing here, especially going into retirement. Do you want your house paid off going into retirement, or do you want to have the lowest payments as possible leading into retirement to put money into things like the market? There will be people that will say the market has outperformed real estate because of compound interest, but then there'll be people who say I put money in. So I'm that person. My brother's the opposite. They've dumped everything into their real estate. And if, for example, my brother's not unemployed, but he's manages their real estate. If his spouse, my sister-in-law, loses her job, they're going to have to sell real estate. So
they have options. I
have
always tell
options.
people they have options. And that's
a
key.
good email. I think a lot of people should consider looking at their term, whether they're going to shorten it or lengthen it based on how they're going to retire. We'll come back after this break here on AM 1220 KDOW. Call the show, 800-516-1220.
Money 2.0 on AM 1220 KDOW.
Tried to clear my empty head of those words that were never said. Sat alone in a hood, my drone, and out when the wind would change direction.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
can always call the show 800-516-1220 to get your calls on the air. 800-516-1220. Shoot us an email, Tony@BayAreaLoanSource.com or Gordon at BayAreaLoanSource.com. So one of the interesting topics that I ran across, it's kind of the theme school started, is buying near a school. Or it could be a high school, it could be an elementary, it could be any kind of school. There's definitely some disadvantages and some advantages. The obvious ones, walking distance, of course, if your kid goes to that school. Possibly, this is a weird one that I ran across. Higher home, but only if it's in a good school district. Safer neighborhoods. There's more police presence and tighter rules on violence and drugs. Access to schools and after-hours facilities if they're not locked up. And some of the disadvantages can be harder to sell. You're limiting the pool of buyers that will actually look at a house right there. But noise is something that I lived near a school at one point, and it was noisy. And I told myself that I would never live near a school again. I'd want to be 2 or 3 blocks away instead, so I kind of get the fewer kids, the fewer cars, and that, which is the other part of this, is the traffic and foot traffic from the kids, and then events that could happen, football games and so on, bands. I can hear from where I live, and I'm several blocks. I'm probably 10 blocks away from the high school. And I can hear the bands and football games. I can hear the cheering and everything like that. I couldn't imagine what it'd be like right across the street on an intimate night with my woman.
Well, actually, they said that one of the best things that can happen to a home is appreciation. And one of the best things that brings good appreciation is a good school district, especially for younger families. People buy around school districts, so they'll pay more. Because the opposite is you go to a different neighborhood, you're going to end up spending money anyway. You're going to put your kid in private school, and there's no tax deductibility in doing that. So there's a lot of different great reasons to buy a house in great school neighborhoods and great school districts, like you say, and that's why you always tend to see a great appreciation. It's community. A lot of police departments have gone to what they call community police, and they want the police officer to walk the local beat. There's nothing, man, like a kid getting out of school, middle school, riding his bike 3-4 blocks or walking to school. I love to see that in neighborhoods, but all those cars coming and dropping kids off and picking them up, that's not community schooling. I like to see the kids ride and walk into school. Great thing to see.
So say you identify a good school district, which we all know that's on the top of the list. I think for most buyers is good school district. Can you be too close to that school?
Well, of course, if you're across the street from school, I remember when my kids used to go to school, I used to drop them off, and I would hate to say I would hate to be one of those people who live directly across the street from the school in the mornings with all the traffic coming in, around 2:30, 3 o'clock with all traffic coming out. It's just a nightmare for those people that live there. And they had all these signs, please respect our neighborhood, please don't park, don't block the driveway.
Don't speed.
And so it's an interesting thing to live directly. But in the summertime when the school is out, it's a piece of cake. But during the wintertime or during the school year, it's challenging. It's a nuisance. So it's just something you have to live with.
So good school district, but not too close.
Not too close.
All right. So we may see those.
Have your cake and eat it too. If you're going to call it, you might as well call everything you want to do that's going to benefit you, right?
One of the other topics, a lot of kids are going back to college soon. Buying a house for your college-bound child. Okay. It's on number 5 on my list of strategies to build real estate or a real estate portfolio based on risk levels. Obviously, you can buy a house and that'd be the only house you ever own. You could buy a primary house and then turn it into a rental and then buy another one. You can buy a primary residence and then buy other investment property using some cash that you've accumulated. Or you can buy primary residence and then buy investment property leveraging your primary residence. You can buy a property for your kid in college, or you can be a renter and buy real estate. So these are some of the risk levels that people go through when they're buying real estate. And I think I covered most of them. And there's several variations to this, but I ran a quick scenario of what it would be like to go to Cal State Chico. The room and board in the United States, the room and board right now runs for a 4-year college about $10,400. Chico is $11,800. 65% of that you think is about the room is $7,600 a year, or that college year. Median home price in Chico is $314,200. 20% down is $62,000, leaves a loan of $251,000. Payments on that, including tax and insurance, about $1,700 a month. So the room costs about $958 per month. Let's say it's about 8 months. So you have some negative cash flow, but you have a house that your child will live in and get some roommates that could pay $500-$600 a month. Maybe you have 2 roommates. You have a 2 or 3 bedroom house. And how do you see how the scenario is playing out?
Well, if you go back to the same concept we talked about, we're talking appreciation. My daughter went to Santa Barbara College, and when you went down there and you saw all the housing that's not around the high school, but it's around the college, I mean, these people are actually doing very, very well because they're renting not rooms, but they're renting space. You might have 4 students in a 1-bedroom house because they're renting space, and that can be very profitable to be a landlord. We had a guy that's called the show the other day, I think from the Fremont area. His daughter was going to be a freshman here at UC Berkeley, and he was trying to get us to finance a duplex close to the campus, which his daughter can move in, be a resident, and that took care of the housing piece of the piece of his expense of trying to finance his daughter's education. So those are all great strategies. You know, college towns always tend to do well.
The income's seasonal. There's a little bit more wear and tear that you have to get. You have a lot of turnover.
Yeah.
And it's not a passive investment, meaning you're just not going to buy it and not expect to go there on a regular basis. That's, of course, if you have a responsible child. Now, it might not be the first year or the second year that your child's in school. In fact, they may be switching schools, and it may have backfired on you. But
well, you put it in the property manager's hand. That's what. Go back to our theory. Professionals is all about. We like to talk professional, so we use a property manager to manage that property. You know, collect the rents and make sure everything stays well in that school, especially if you're an absentee or a long distance homeowner.
Gives your child some experience in real estate. They start learning some good life lessons early in life that they can take forward. And all of a sudden you have this beautiful house in it may not be beautiful after that party, but it's a beautiful house that he can manage and call his own for the most part. Start that investment portfolio. So there are some strategies that you can kind of play into the school season.
Well, I had a friend of mine a few years ago. That was his strategy. He had 3 daughters, and he bought 3 homes as soon as they entered, first grade. And he said, these homes are going to pay for my kids' college education. So if you look at appreciation that we've had, could you imagine how much appreciation you would have in about a 10-year run? So there you have it. That's enough money to pay for that college education in cash, probably over the 4-year period.
There are some good strategies. We're here to help you, give you a second opinion. You're always welcome to shoot us an email, Tony@BayAreaLoanSource.com or Gordon@BayAreaLoanSource.com. I'm Tony Mendes. That's Gordon Hines. We'll come back after this break here on AM 1220. This is the Real Estate Report.
This is Money 2.0 on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendes.
And I'm Gordon Hines.
You can call the show 800-516-1220, 800-516-1220. You can also email the show, Tony@BayAreaLoanSource.com. We got an email from Sam in the Bay Area. He's looking to buy a house in Sacramento. He said he talked to a lender, and the lender declined him because the distance away from his primary job is too far. He's still working here in the Bay Area but wants to buy a house in Sacramento. And he asked, are lenders allowing buyers to buy primary residence with this kind of distance? You know, this is kind of a tricky one, Gordon. Some lenders will and some lenders won't. FHA is going to be a little tighter than on a conventional Fannie Mae or Freddie Mac loan. But the good news is there are lenders that will do this. We just did one for a firefighter, and he bought a primary residence in Tahoe, and the lender underwrote the loan like that. Okay, we did have to prove that it didn't affect his job, and that will likely be one of the conditions of your scenario. You will. What are some of the other?
Well,
things
it depends on if you're buying a primary residence. That's within normal commuting distance. The lender is going to have a problem with an owner-occupied type deal. They're going to say, look, you're not going to live there. You got to do it non-owner. But if you have a type of job like a firefighter, those guys can work 2 days on and 5 days off, vice versa, whatever they want to do. Policemen can do the same thing. That's not a far stretch. I did a loan a couple of years ago, same thing. A lady was buying a house down in San Diego. She lived down almost in the Mojave Desert. She was only required to work in the office 2 days a week. We got a letter from her employer saying she can do telecommute, and we were able to close a loan of our own occupied type deal. So it all depends on how savvy your lender is, and depends on, does it make sense? If it makes sense, you can sell the story. We can probably get that deal.
It's a little harder to shop for this type of loan as well as an individual, because you're going to go through a whole process just before they're even going to tell you whether or not they'll do it, where a broker will, like us. And I think that is it scares some people. But I do like the whole idea of people, finding affordable housing, finding a job or a way that you can have your job be able to telecommute, and next thing you know, you have a nice home that you can live in and a new community. I like the strategy. Sam, give us a call because I know we have lenders that will do it. So rates are low, or it's all relative. Rates are staying low. They're a little bit lower than where they were last week, and a little bit lower than the week before. A lot has to do with with the Fed meetings coming out. Trump's doing some things. The market's kind of getting shook up, and refinances are picking up about 3% over the last week.
Well, as we always talk, market works on energy. Anytime there's something that goes in to energize the marketplace, you're going to see the market roll either left or right. And as you see, the economic news that's been coming up, every time the president, pontificates on some issue, it affects the marketplace. And that's how the market is very volatile sometimes. And sometimes it's a knee-jerk reaction. You'll see the market, especially the stock market, for example, it'll bomb off 40 points, 50 points in a day. And then the next day you'll see it come back and pick back up those losses.
And that translates right into the bond yields, which translates into mortgage rates. And like I said, refinances are picking up, which is good news. They're back up to about 37% of the whole market. But what that also means is you're going to get a lot of ads. You're going to get a lot of stuff in the mail asking you to refinance. So be careful. Not everybody needs to refinance, but there are a lot of people who should. Look at your scenario. Have a professional look at your scenario. See if it makes sense.
Now have us look at your
We
are the professionals.
You can go to our website, BayAreaLoanSource.com, BayAreaLoanSource.com, and you can always email us there if you have any scenarios you'd like to go over. Get your emails on the air. Thanks for joining us this week. Gordon, any last words?
Oh, man. Time goes so swiftly sometimes. I didn't even get my, this day in history. Woodstock,
okay.
Jimi Hendrix closed out Woodstock. Today is Robert De Niro's birthday. I couldn't find anything else real estate related. But next week, I guarantee I'll have something for you.
Thanks for joining us. Don't forget you can go to our website, BayAreaLoanSource.com, if you have any emails or questions. Thanks for joining us.